our module B, and we will cover all the MCQs of module B, that is risk management, a most important module for your CAIIB BFM examination. So let's get started with all the MCQs and we will learn all the concepts here. Okay. I am hoping that you all are good, and also I am audible, I am visible, and also my screen is visible to all of you. So let's get started with today's video. Module B consists these units, and all these units are very important in module B. So first here the unit name is risk and basic risk management framework. Okay, so we cover all the MCQs by the unit wise and then see the concepts behind these questions. So let's get started and see here our first question. So first question is saying investment in the post office time deposit is basically zero risk investment, low risk investment, medium risk investment, or high risk investment. Okay, if I talk about the zero risk investment, this is an investment which is considered have no risk and is expected to yield a known rate of return. If I talk about the low risk investment, these are like less likely to lose value suddenly, but they also have a lower chance of higher growth. And medium risk investment or moderate risk investment, also these are known as medium risk investment and return investment, which occupy the sweet spot between low risk and the high risk options. And the high risk investment, this is an investment that has a higher chance of losing money. In this higher chance of losing money, and also if we compared other types of investments, in this there is a higher chance, and also if there is a higher chance of losing money, so there will be higher potential for the returns. Okay, so the correct answer in this, if we talk about the investment in post office, is like zero risk investment. If you are investing in post office, there is no risk, so we can say this is a zero risk investment. Okay, moving to the next question. Zero risk investment implies zero variation in cash flow from investment in zero coupon bonds, investment in corporate bonds, and investment in fixed deposits. See, if we talk about zero variations in cash flow from the investment, this means that the investment will provide a predictable and consistent return with no risk of loss. This is defining the character of a zero risk investment. And if we talk about the investment in zero coupon bonds, well, zero coupon bonds basically offer a fixed return of maturity. They are not considered zero risk because their market value can fluctuate before the maturity, we can say. And if we say investment in corporate bonds, this type of corporate bonds involves the risk of default, meaning the issuer may not pay back the principal or the interest. Therefore, they are also not zero risk investment. And if we talk about the investment in bank fixed deposits, While bank fixed deposits are generally considered relatively safe, they are not entirely risk free. The bank could fail, leading to the loss of the deposit. Additionally, inflation can uh, erode the purchasing power of the fixed return. So here the correct answer is zero investment implies where there is zero variation in the cash flow from the investment. Okay, understood. Then moving to the next question here. Which of the following statement is correct? Tell me, after reading the four options, just tell me which of the following option is correct here. See, first option is given here. Higher the risk would be risk premium. Higher the risk, lower would be risk premium. Lower the risk, higher would be the risk premium, or none of the correct. None of the above is correct. Basically, we talk about the correct answer here. The correct answer, higher the risk, higher would be risk premium. Risk premium is basically an extra return. This is considered as an extra return that an investor expects to pay, uh, or expects to, not using the correct word pay here, we can use the correct word earn, expecting to earn for taking an additional risk. And risk, we know that it is in potential for loss or something negative outcomes in an investment. Therefore, it is logical that investors would demand a higher return for investing in assets that carry higher risk. This is because they are compensating for the potential downside of the investment. That's why higher the risk means higher would be the risk premium. Next question, which of the following is correct? Higher the risk in a business, higher would be capital requirement. Higher the risk in a business, higher would be the return expectation. Higher the risk in business, higher would be capital requirement, and higher would be return expectation, or the none of the answer is incorrect here. Clearly, if we talk about the options, if we see the options, if we carefully read the options, here the correct option is option C. That is, higher the risk in business, higher would be capital requirement, and higher would be return expectation. Why? Higher capital requirement means businesses basically with the higher risk typically require more capital, and more capital to operate, obviously. This is because investors demand a higher return for taking on more risk, because if they are taking more risk, they demand for the higher return. And this is because investor demands for taking on more risks, the business needs to have sufficient funds to cover all the potential losses. And higher return expectation, we can say investors in the higher risk businesses expect a higher return on their investment to compensate to their increased risk. This is why business needs to offer a higher rate of return for attracting the investors. And we can say both higher capital requirement and higher return expectations are associated with higher risk in business. Understood? Moving to the next question here. What is the most crucial function of risk management? What is the most crucial function? Four options are given. I think these four options are there when we do risk management, but which is the most crucial function? If we talk about first option, that is controlling the level of risk to an organization's capacity. See, this is the ultimate goal of risk management. Why? Because it involves taking steps to reduce the impact of negative events on the organization's ability to achieve its objective. This might involve avoiding risk altogether, mitigating their impact, of transferring them to another party. And if we talk about the identification risk, basically, while identifying risk is an important step, but it is not the most crucial, because the real value lies in taking action to manage those risks. Okay, and estimating the cost of risk, basically estimating the cost of risk can be helpful, but it is not the primary goal. This basically focuses on the controlling the risk themselves. And the measurement of risk, measuring risk can provide valuable information, valuable insights, but it is not the most crucial function again, because this is the key that use information to make informed decisions about how to manage the risk. Therefore, controlling the level of risk to an organization's capacity is the most crucial function of risk management. That's why this option is correct here. Controlling the level of risk to an organization's capacity. Great. So both are fifth correct. Fifth option, A answer is correct. Moving to the next one. When compared to return of equity, return on asset, RAROC is better performance measure, because read all the options and then I will tell you what is the meaning of RAROC and also tell the full form of RAROC. RAROC, we know that this is risk adjusted return on capital. Basically, this performance measures considering both the return generated by an investment and the risk associated with that investment. It calculates the expected return per unit of risk. And if we talk about the return on equity, that is ROE and ROA, basically these are the traditional performance measures which focuses only on the return generated without considering what the risk is involved. RAROC is better performance measure because it factors the risk taken by the organization basically to achieve its returns. This provides a more comprehensive and provides the accurate assessment of an investment's profitability. So here we can say that the correct option in this is it taken into account the risk undertaken by the organizations to get the returns. Option D is correct here. Great. So both are sixth question, option D is correct. Now moving to the next unit. First question is capital charge components of pricing accounts for capital charge component of pricing accounts for. First one, what is the capital charge component in pricing? Basically it refers to the cost of capital that a company must consider when setting the prices setting the prices for its products or services. It is essentially the minimum rate of return that the company needs to earn on its investment to satisfy its investors. And if we talk about the cost of capital, this is the basically minimum rate of return also that an organization must earn on its investment to satisfy its investors. Basically, it includes the cost of equity and the debt capital. And if we talk about the internal generation of capital, this refers to the funds that an organization generates from its own operation, that is basically called profits, and these funds can reduce the need for the external financing and also lowers the cost of capital. And loss provision, basically this is the provision for potential losses that an organization may incur. It also helps to ensure that the organization has the sufficient funds to cover the unexpected losses. So here if we talk about statement third and statement 1 is correct in this case. Seventh option, fourth option is correct here. Cost of capital and also the loss provision. Okay. Moving to the next question. Daily volatility of a stock is 0.5%. What is its 10-day volatility? We know that for calculating, here is given 10-day volatility. So we need to multiply the daily volatility by the square root of the number of days. That means 10-day volatility here can be calculated as daily volatility multiplied by square root of 10 days. Okay, because we have to multiply it by square root of the number of days. Okay, so when we calculate it, it will be 1.58%. 1.58%. So third option is correct. So this is the formula here. This is the formula which is useful to find these types of questions. Understood? Not Abizar, here third option is correct. Okay, hope you understand what I am trying to saying here. The third option is correct, not second. Now risk mitigation results in, risk mitigation is what? It is basically whatever the steps are taken to reduce the potential effects of negative events. This typically involves the actions basically that reduce the likelihood or the severity of risk. And if we talk about the reduction of downside potential, basically by mitigating the risk, the organizations can reduce the potential for losses and also the negative outcomes. This is the primary goal of risk mitigation. And reduction in profit potential, basically while risk mitigation can sometimes have the unwanted or unintended consequences of reducing the profit potential, but this does not means that this will be always the same in all case. in some instances or many instances, risk mitigation can actually improve an organization's profitability by reducing the likelihood of costly mistakes or disruptions or the obstacles, whatever the obstacles are come. So we can say that both are correct in this matter. So this one, all the statements are correct, is the correct answer here. Both is correct here. In risk mitigation, both is correct. So both sir. So option first is correct here. Okay. Now, from 1st of April 2020, RBI has mandated the banks to link their interest rate on retail loans to an external benchmark which is developed by dash to the RBI's repo rate. If we talk about from 1st of April 2020, basically the Reserve Bank of India mandated to banks to link their interest rate on retail loans to either an external benchmark which is developed by the financial benchmark India Private Limited to or to the RBI's repo rate. This move was aimed at to increasing the transparency and also reducing the interest rates charged to the borrowers. Okay. Basically, if we talk about the FEDAI, we know that this is Foreign Exchange Dealers Association of India, and it is a self-regulatory organization which is established in 1958 to oversee and regulate the foreign exchange that is also called forex markets in the India. And if we talk about the FIMDA is Federation of Indian Money Market and Derivatives Association. It is also a self-regulatory organization that represents both the interest of various market participants in India, which includes banks, financial institutions, brokers, and these are involved in money market and derivatives segment. And Clearing Corporation of India, CCIL in short we are saying this is a financial market infrastructure that provides clearing, settlement and depository services for a wide range of financial institutions in India, and it is a wholly owned subsidiary of the RBI. Wholly owned subsidiary of the RBI. So keep in this mind, but the question here, answer is correct is option C. Great. So both sir, Abhi sir, 10th option C is correct. Moving to the next question. So next unit, financial risk, that is risk regulations in banking industry, a very important chapter in the BFM subject and module B, a very important and very complicated, little bit complicated chapter. So here is the financial risk is defined as, what is the meaning of financial risk? If we talk about this financial risk, basically financial risk is the potential for the financial loss or the damage to an organization due to some unforeseen events or the circumstances. It can arise from various types of sources which include market risk, credit risk, liquidity risk, operational risk and legal risk. What is market risk? We know that when there any type of fluctuations or any type of change in the market prices such as interest rate, exchange rates and commodity prices, that means market risk will be there. Credit risk when the borrowers fails to repay the payment, when borrowers are not meeting their obligations, that is the credit risk. And liquidity risk when the bank have not the enough cash basically to meet their obligations. And operational risk means internal failure, and some type of external events can be included in this. And legal risk, this is the risk of financial loss due to legal issues such as lawsuits, regulatory fines, non-compliance with laws and regulations. Okay, so here if we say financial risk is defined as, this is defined as the variations in the net cash flows. When there is variations in the net cash flows, then obviously financial risk will be there. Okay, so option D is correct here. Option D or option A? No, option D is correct here. Because financial risk will happen when there is the differences in the net cash flows. That's why option D is correct here. Now strategic risk is a type of strategic risk here is a type of an interest rate risk, credit risk, liquidity risk, and none of the above. Good morning, Ajay sir. I am fine. How are you? See, if we talk about the strategic risk basically is a type of risk that is arises from an organization's overall business strategy or direction. It is the risk of managing incorrect strategic decisions that could lead to the financial losses or missed opportunities. So, strategic risk is not an interest rate risk, is not a credit risk, is not a liquidity risk, because it arises from the organization's business strategy. That's why we can mark here option D is incorrect, that is none of the above. Then next question. Yes, so what's the correct? 12th D answer is correct here. Strategic risk example can be like if there is any policy which is made by the organizations, but that policy or that procedures provides the direction to overall organization to achieving its goal. So that can be the example policies in the procedures whatever made by the organizations to be stable in the market, to become competitor for other organization or other institutions. That can be the example if there is any default in that policies or in that procedures, that will be the risk for that organization, like wrong decisions. A bank funds its assets from a pool of composite liabilities. Apart from credit and operational risk, it faces basis risk, strategic risk, reputational risk, or compliance risk. First one is here. Just read the question and then read the options. See, if we talk about the basis risk, this is basically uh, difference. We can say difference between the spot price of an asset. Spot price of an asset is the current market price at which the asset can be bought or sold for immediate delivery. And basis risk is the difference between the spot price of an asset and the price of an related derivative contract that will change unexpectedly. And if we talk about the derivative contract, it is an financial instrument which is basically derived from the value of an underlying assets. Okay, and these underlying assets could be a stock, could be a bond, could be a commodity, and also currency or the index. And some common examples we can take of underlying assets like stocks, shares of a company traded on a stock exchange, bonds like debt securities which is issued by the government or the corporations, and the commodities like raw materials such as oil, wheat, gold, or coffee, because these are the examples of commodity. And also the currencies, that means the foreign currencies. So here, strategic risk, reputational risk is that risk in which the loss to the reputation of the company or the goodwill of the company, which people having some type of negative perceptions or adverse publicity, it can arise from a lot of factors are there, like some ethical or legal violations, and also like product or service failures, some environmental and social issues, we can say that, and also some public relations crisis are also included in reputational risk factors. And if we talk about the compliance risk, this is the risk of financial loss or the damage to the organization which is occurred due to non-compliance with the laws, regulations, or the industry standards, and it can be also arises from a lot of factors which includes like regulation changes, some internal failures, and the external failures. So here a bank basically funds its assets from a pool of composite liabilities. Apart from credit and operational risk, it faces basis risk. Yes, so both sir. 13th question, A option is correct here. Now, question is saying a branch sanctions rupees 1 crore loan to a borrower. Which of the following risk the branch is taking? Liquidity risk, interest rate risk, market risk, credit risk, operational risk. And all these risks are the meaning of all these risks, just tell me a branch that sanctions 1 crore loan to the borrower. Which of the following risk is branch taking? See, when a branch sanctions a loan to a borrower, basically in this case, the primary risk it takes is the credit risk. Basically, this risk is that risk. Why primary risk? Because in this risk, borrower will default on the loan, meaning they will be unable to pay the interest or principal. But here is also liquidity risk, here is also the chances of interest rate risk, here is also the chances of credit risk, because this is the primary risk in this type of transactions, and also the operational risk. So we can say that our fourth option is correct, that is 1, 2, 4 and 5 only. Now, premature payment of a term loan will result in interest rate risk of type basis risk, yield curve risk, embedded option risk, and mismatch risk. Premature payment. Premature payment, this term means that paying off the loan before its scheduled maturity date. And you know the meaning of basis risk. Yield curve risk, basically this is a type of interest rate risk that is arises from the changes in the shape of yield curve, which is basically the graph that shows the relationship between interest rates and the time to maturity for the bonds of different types of maturities. And here embedded option risk, if we talk about, is it is a type of interest rate risk that arises when a financial instrument contains an embedded option. Embedded option is a right or we can say right or holder of the instrument to take certain types of actions such as early repayment or changing the interest rate. And if we talk about the mismatch risk here, mismatch risk basically is that risk in which an organization's assets and the liabilities have a different type of maturities or some interest rate sensitivities, which can lead to financial losses in the event of interest rate changes. So here premature payment of a term loan will result in the interest rate risk of type of embedded option risk. So the 15th question, option C is correct. Now, an entity which is having a credit sale of rupees 20 crores for the financial year which is ended 31st March 2021. Now, profit on the sale is 10%. The entity has booked a profit of rupees 2 crore as on 31st March 2021 on the credit sale before actually getting the cash from the depositors. From this statement, it can be deducted that the firm is following. Four options are given. First one is cash system of accounting. Cash system of accounting, basically this system is recognizes the revenue only. Revenue only when the cash is received, and expenses only when the cash is paid. And this is incorrect here. Why incorrect? Because in the given scenario, whatever the given in this question, the company has recognized a profit of rupees 2 crore before receiving the cash, which contradicts here the cash system. And if we talk about this discounting system of accounting, discounting system of accounting is not a generally recognized accounting method. This is not a recognized accounting method. It is might refer, we can say, the specific techniques which is used by the certain types of industries or in some types of situations, but it is not a fundamental accounting principle. And this is incorrect also because there is no indication that the company is using a discounting system in this scenario. There is nothing given. If we talk about this accrual system of accounting, accrual system of accounting basically recognizes the revenue when it is earned. uh, Here, when the cash is received, it is not important, and the expenses when they are incurred, regardless when the cash is paid. And this is correct here because, see, company basically recognized a profit on the credit sales before receiving the cash, which aligns with the accrual system, and this indicates the company is following accrual system of accounting. And forecasting system of accounting means, as the name is saying, that this is not a method of accounting first of all, and it is the refers to the process of predicting the future financial performance. So this is incorrect here. The option C is correct, that is accrual system of accounting. Okay. Now, next unit MCQs, market risk. So first one is systematic risk is the type of, what is the meaning of systematic risk? And the four options are given here. Just read the options and give the answer. If we talk about the strategic systematic risk, systematic risk is the risk in which there is a breakdown of the entire system. Here we can say this is the breakdown of the entire system, uh, rather than simply failure of the individual parts. So by seeing the options D, we can say here option D is correct. In this, failure of entire banking system is there. Okay. Now, central bank governors of G10 countries participating in the Basel Committee on Banking Supervision. So here are the total number of members. Now, what is this BCBS? This is Basel Committee on Banking Supervision. It is an international organization. And what this international organization do? This basically setting the standards and setting the standards for banking supervision and the regulations globally. Basically, Basel Committee comprises here 45 members from 28 jurisdictions, consisting of the central banks and the authorities with the formal responsibility of the supervision of banking businesses. And if we say here, group of 10 is made up of 11 industrialized nations that include central banks from the Germany and Sweden, as well as some government from the Canada, Belgium, Switzerland, Canada, Belgium, France, Italy, Japan, Netherlands, Switzerland. and also the UK, not Uttarakhand, United Kingdom. Okay, 10 are done. Basically, here we can also include US. This G10 was established in 1962 to lend the money to the International Monetary Fund, that is IMF, and this G10 basically, these members are doing meeting just because uh, for debate, for discussion, and for cooperation on the international finance. Okay. Now this 1988 Capital Accord framework accounted for. See, four options are given. If we talk about the 1988 Basel Capital Accord, it is also known as Basel I. And this is the earliest of the three Basel Accords and introduced the capital reserve requirements for the banks, which is based on the riskiness of their assets. Okay. So 1988 Capital Accord framework is accounted for here: credit risk, market risk, and the defined capital component. Market risk, capital risk, defined capital component is type of a specific amount of capital that a financial institution is required to hold as a cushion against potential losses, and this requirement is typically mandated by the regulatory bodies to ensure the stability and the solvency of the financial system. Backtesting means, backtesting is done. Why? Backtesting is basically done to compare the model results and the actual performance. It is basically the process which is used to evaluate the historical performance of a trading model, and or the strategy, we can say, by applying it to the past data and comparing the stimulated result of the actual outcomes. This basically helping in assessing the model's effectiveness and identifying in potential shortcomings before any type of thing which is deploying in the real world trading. Okay. Yes, Panga sir, good. If we talk about back testing, it is type of a technique in which is evaluating the historical performance of the trading strategy of any model, of any system, and by applying this model to the past data and comparing to the simulated result, everything is identified here before any type of deployment. Under Basel II, capital requirement under the accord is, if we talk about the Basel II, the capital requirement is determined by the regulatory authority. determined by the regulatory authority, which is based on the bank's risk profile. This means that is the amount of capital a bank needs to hold is not fixed but varies depending on its specific risk. Basel II is a set of international standards which basically governs the bank's capital adequacy, market discipline, business practices, and it was developed by the Basel Committee on Banking Supervision and a committee of central banking governors and the banking supervisors from major economies. So, under Basel II, here capital requirement under the accord, the capital is specified by the regulatory authority and is required to be maintained. Now, capital charge for credit risk requires input for PD, LGD, EAD, M. These all are these are the four key component which is used in calculating the credit risk. These credit risk is calculated under the Basel I and Basel III frameworks. It is used for calculating the calculating the credit risk, and they are used to determine the capital requirements the bank must hold to cover potential losses from loans and other type of credit exposures. So this is basically under the advanced IRB approach. Banks are allowed to use their own internal models in which they can calculate their capital requirements for the credit risk, and this also providing the input for loss given default, that is LGD. Banks are responsible for developing and validating their own LGD models subject to the regulatory oversight, and this BCBS committee basically provides guidelines and the frameworks to the advanced IRB approach, and it does not directly provide the input for the LGD. So here we can say option C is correct, that is no. Here option bank is correct. Capital charge for the credit risk requires input under advanced. Who provides the input for LGD? Bank provides the input for LGD. Yes, 22 option A is correct. Great, Anita ma'am. Now, under the standardized approach, the rating assigned by the eligible external credit rating agencies will largely support the measure of four risks are given. If we talk about this standardized approach, it is basically the rating which is assigned by the eligible external credit rating agencies, which largely support the measure of credit risk. This standardized approach is the simpler method for calculating capital requirement under Basel II, and it uses pre-assigned risk weights based on the credit quality of the exposures as determined by the external credit rating agencies. And also these external credit rating agencies used to access some other risks like market risk, operational risk, but they are primarily used for the credit risk. So here the option credit risk is correct. Correct, Anita ma'am. 23 option B is correct. Under the RBI Basel III norms, DSIFI will be plotted into dash different buckets and would be required to have additional common equity tier 1 capital requirements. See, if we talk about the RBI Basel III norms, this domestic systematically important banks are categorized into 5 types of different buckets, which is based on their systematic importance, and each bucket corresponds to a different level of additional common equity tier 1 capital requirement, that is CET1. The higher the bucket, the greater the additional capital requirement. And this system is designed to ensure the larger, more complex banks that had a sufficient amount of capital to absorb the potential losses and maintaining the financial stability. And basically these norms are the regulation which is implemented by the RBI and based on the international Basel second capital standards. And if we talk about this DSCFI, DCFI banks, these are the large financial institutions because due to their size, due to their complexity, due to their interconnectedness, they could pose a significant risk to the stability of the financial system if they were failed. These banks often also playing in the important role for providing different types of financial services to the individuals and some other financial institutions. And if we talk about the CET requirement, it is considered the highest quality of capital for a bank. So here 5 buckets, that means option 5 is correct here. Okay. Now first question of next unit, that is 26th question basically. An 8-year 8% semi-annual bond has BVP of rupees 125. The yield on the bond has increased by 5 basis points. What is the profit or loss suffered due to increase in the yield as holder of the bond? Here we can calculate it. VVP basis point value of 125 means that every 1 basis point increases in yield, then the bond price decreases by rupees 125. This yield increased by 5 basis points. That means we can say that loss is equals to VBP multiplied by change in basis points. So here that is 125 multiplied by 5, which is equals to rupees 625. So there is a loss of rupees 625. Okay. Next question. one day here of a portfolio that is value at risk is rupees 5 lakh with 95% confidence level, and in a period of 6 months, that 125 working days, how many times the loss on the portfolio may exceed rupees 5 lakh. So this one day value at risk represents the maximum potential loss on a portfolio over a single day with their 95% confidence. It means that there is a 5% chance of the loss if rupees 5 lakh is exceeding on any given day. Time period is given, that is 125 working days and 6 months. Now we have to calculate the expected number of exceeds here. So first for this we have to calculate 5% of 125, that is equals to 6.25. 6.25 days, that means near about 6 days. That means option C is correct here. Okay. Now next question. A bank suffers a loss to adverse market movement of a security. The security was however held beyond the deficiency period. What is the type of the risk that the bank has suffered? A bank suffers due to adverse market movement of a security. See, deficiency period is basically refers to that time frame during which a financial obligation or liability is replaced or fulfilled through a process that is known as deficiency. In this we can say that the security was held beyond the deficiency period, which implies that bank did not follow its internal policies. When the internal policies or procedures are there, then that means we can easily mark here option B is correct, because in operational risk there this risk is including failure of internal policies, and this type of failure is adhering to the internal controls, guidelines and the risk management practices which is considered in the operational risk. Okay, so the correct answer is operational risk. Why option C? Option B is correct, because here we are talking about the internal failures and the guidelines. So these types of risk comes under operational risk, not in market liquidation risk. Okay. Moving to the next one. Now bank holds a security that is rated A plus. The rating of the security migrates to A. Why? Which type of bank risk is there? See, if in any type of bank there this type of downgrade affects the bank because value of the security decreased, so it may be riskier to hold and it always reflect the credit risk. And we know that credit risk is that risk in which a borrower is failed to repay the payments or give the money, or in or fail in meeting the obligations. So basically credit risk is that risk which is the risk loss due to the deterioration in the creditworthiness or default of the counterparty. In this case, the security rating has migrated A plus to A, indicating that there is a decline in the credit quality of the issuer, which increases the likelihood of the default and downgrade in the future. So that means this is the example of credit risk. Understood? Next question. Here you have to tell a bond with remaining maturity of 5 years is presenting the yield of 6%. Its modified duration is 5%. So what is its Macaulay's duration? We know that there is a relationship between modified duration, that is MD, and Macaulay's duration, that is also MD, and MD is equals to MD, that is equals to the divide by the 1 plus I. This one MD is not McDonald, this is the modified duration, and this one is the Macaulay's duration, and this is why is the yield to maturity. So here MD is given, that is 5%, modified duration is given. Now we can substitute, that is equals to 5 is equals to MD divide by 1 plus 0.06, because we can write 6% as 0.06. So this MD is equals to now 5 multiplied by 1 plus 0.06, that is equals to 5.30 years. So the correct answer is option C. And if we talk about the modified duration, it is the measure of the bond's price sensitivity to changes in the interest rate, and it indicates basically the bond price will change for a given change in yield. And if we talk about the Macaulay's duration, this is also a measure of the average time to receive the cash flow of a bond, and it is expressed in time such as years, and also yield to maturity, in short, which is a YTM. YTM is the total expected return on a bond held to the maturity, and it takes into the account the bond's coupon payment, purchasing price, and the price at the maturity. Next question. VAR, that is value at risk, is not enough to assess the market risk of a portfolio. Stress testing is desirable because why? Stress testing is used to evaluate the resilience. And this resilience is basically evaluating the resilience of a portfolio under extreme or unusual market conditions which are not captured by value at risk. So basically, value at risk is not enough to assess market risk of a portfolio. Stress testing is desirable because it basically helping in assessing the abnormal movements of market parameters. And stress testing is also a technique of a financial of risk management, which helps in measuring the financial institutions and also in evaluating the financial institution to evaluate the potential impact of the extreme market conditions or if there is any adverse scenario is present. Okay. So now conditional value at risk is also called as dash method. Expected shortfall, expected surplus, unexpected shortfall, and unexpected surplus. If we talk about this expected shortfall, this is the measure that measures the average loss that occurs beyond the value at risk threshold, providing a more comprehensive view of the risk and the potential losses in the extreme market conditions. And this surplus, this is very less commonly used in risk management because this is also not having a standard definition. Um, if we talk about what is this is the gain that an asset that in achieved by exceeding a certain type of limit, but this is not having any type of relationship with the risk measures like conditional value at risk. So here we can say option A is correct, that is expected shortfall. Moving to the next question. Which of the following is not a type of credit risk? Which of the following is not a type of credit risk? Default risk, spread risk, intrinsic risk, or basis risk. Default risk is that risk that a borrower or the counterparty will unable to meet their financial obligations, such as failing to make scheduled interest or principal payments as a loan or bond. Credit spread risk is that risk, basically that loss which is arises from the changes in credit spread of a financial instrument, particularly bonds, and this intrinsic risk is not widely defined in the terms of finance and the risk management. And you know that what is the basis risk? I told you earlier, this is the risk that the value will not move to the perfect correlation with the value of whatever the assets is hedged. So basically credit risk is not related anyhow with the basis risk. So option fourth is correct here. 33, option fourth is correct. Risk of a portfolio with overexposure in steel sector will be, see, a portfolio that is heavily weighted in the steel sector is likely to be significantly affected by the industry specific risk, such as if there is fluctuations in the commodity prices, changes in the regulations, and the market demand specific to the steel industry. Systematic risk, we know that what is this risk which affects the entire market. Okay, So if we talk about this, risk of a portfolio with overexposure is here more than systematic risk. Next, the risk that is arises due to the worsening of credit quality. Worsening of credit quality. Basically, here the correct answer is credit spread risk. Okay. Next question. In develop our capability to actively manage our credit portfolio, one must have in the place of the following. The four options are given here. Credit rating model, developing and maintaining here the necessary data on defaults of borrowers rating category wise rating migration. See, having a credit rating model is also here essential for assessing the credit worthiness. It is essential for the credit worthiness of the borrowers, and developing and maintaining necessary data on the defaults of borrower rating wise category rating migration. Basically, in this we can say that it is important, which is refers to the movement of any type of any type of changes between the borrowers and different type of rating categories. So here both are required to managing the credit code portfolio. Now, the model that combines five financial ratios, which is using reported accounting information and equity values to produce an objective measure of borrowers' financial health is. See, if we talk about Altman's Z score, it is the formula which is developed by Edward Altman in the 1960s, which predict the probability of a company which is going bankrupt within 2 years. It combines five financial ratios which is derived under the company's reported accounting information into a single score that provides an objective measure of the borrower's financial health. So this is correct here. And if we talk about the credit metric is basically a model which is developed by the JP Morgan, and it is used to measure the credit risk of a portfolio of loans or the bonds. So here the correct answer is option A, that is Altman's Z score. Are transactions where financial securities are issued against the cash flow generated from the pool of a asset is called. See, if we talk about the securitization is the process of pooling various type of financial assets, basically such as mortgages, car loans, and that can be sold to the investors. These cash flows generated from the underlying asset and are used to pay interest and the principal to the investors into the securities. So here securitization is the correct answer. And as next question is, as per the RBI norms, the case of residential mortgage backed securities, the minimum retention requirement for the originator of securitization transaction should be of the book value of the loans being securitized irrespective of the original maturity. So if we talk about as per the RBI, as per the RBI here, RBI norms regarding the residential mortgaged backed securities, the originator of the securitization transaction is required to retain a minimum of 5% of the book value of the loans being securitized. So this is the 5% is correct here. Okay. Moving to the next question. Operational risk and integrated risk management. Operational risk arises from operational risk is always arised from the failed internal process due to peoples and system and due to external events. So first ABC are correct here. The international convergence of capital measurements and the capital standards which is recommended for operational risk here. See, this international convergence of capital measurement and capital standards basically referred to as the Basel Accords, which is recommending the event-based classification, and this event-based classification is done for the operational risks, and this classification, this classification system basically focuses on categorizing the operational risk events which is based on the specific incidents or the occurrences that can lead to the financial losses. So here the correct answer is option C, that is event based classification. And integrated risk framework are basically integrated risk framework is helping in aligning the capital and reserves with the actual risk they face, and also they are ensuring that they are adequately capitalized to cover all the types of potential losses. uh, so here what are the benefits we can say? I think all of them, because to relate capital and reserves, because to evaluate pricing decisions is also here, in marketing risk transfer decisions. So we can say all of the above here correct. Now what are the rewards of proper management? Proper management rewards of operational risk are: yes, there will be lesser risk capital, there will be cost reduction in operation and competitive edge. So basically option first is correct here. Okay. Now next question. What is the beta factor for corporate finance under standardized approach? Under the standardized approach for credit risk in corporate finance, the beta factor is typically set to 18%. This factor is used in the calculation of the capital requirements for the credit risk, which allows the institution to assess the level of risk which is associated with the overall corporate exposures. Okay. Which process is the process that involves bank's assessment of its operations and the activities against an already listed menu of potential operational risk weaknesses? See, risk and risk control self-assessment is that process. Why? In this, basically this is used by the banks and all the financial institution and they are using this to evaluate their operations and all the activities which is telling the operational risk weaknesses and the problems, and also it identifies helping in identifying the risk which is assessing their impact, evaluating the effectiveness of internal controls. Now, overall responsibility for management of liquidity risk lies with on the board of directors. They are overall responsible for managing the liquidity risk, ultimately with the all the other things, and they are responsible for any type of appetite, any type of framework, any type of guideline, everything. So here board of director is the correct answer. uh, who is playing the role in deciding the transfer pricing policy of the bank and making liquidity cost and the benefits an integral part of bank strategic planning is performed by. See here the ELCO is the correct answer. Why ELCO? This committee is completely responsible for see the bank's balance sheet. Also it includes the management of liquidity risk, interest rate risk, and overall financial performance. This committee is deciding on the transfer pricing policy, and also it also ensures the liquidity cost and the benefits that is integrated into the bank's strategic planning, and this transfer pricing policy is refers to the methods and the principle which is used to determining the price at which services, assets, or funds are transferred between different types of departments. Temporary assets do not include which temporary assets are those the which are to be expected to be converted into cash or consumed within a short period of time, basically in 1 year. So here intangible assets we can say, because such as patents, trademarks, goodwill, that are considered temporary assets because they have a longer term nature and not expected to be converted into cash or consumed within a year. Okay, so here option D is correct. So in the risk management framework of the banks, which risk is called as fatal risk? Which risk is called fatal risk? See, if we talk about this fatal risk, this is the type of risk that have some type of consequences on this organization. If we talk in the context of financial institution, it is associated with those types of risk that can to lead to severe financial losses, and also legal penalties, reputational damage, or even insolvency of the institution. So here we can say risk in the risk management framework, which risk is called as the fatal risk? This liquidity risk is called as the fatal risk. So here we have completed our module B. We see all the MCQs in the module B. I hope you liked the today's session. If you like, kindly give the like and also do the comment, which also helps in motivating me. Thank you so much for giving your time and or attending this lecture. We will meet with our next module MCQs. Till then, take care and keep studying and keep smiling. Thank you, everyone.